Hi everyone, welcome back. Today I want to continue our revision on the macroeconomics, and I will discuss chapter 4. So I hope that you're well and everything is okay. So in this chapter, I hope that you will be able to formally formulate understand the financial market. So we have discussed goods market. We did in chapter 3. I discussed briefly. I discussed how to find the equivalent goods market and different variant examples of a multiplier. Here, I want to introduce the financial market because we haven't really covered that previously. So you need to understand what is money and the function of money, and what determines money demand and money supply in the market, in the financial market, and what are the assumptions are you making about the money supply, and what does the central bank do, right? So under what understand what determines interest rate, i.e. nominal interest rate, i.e. the interest rate you hear announced in the media daily. Show how we can calculate the money multiplier and understand how important the money multiplier in money creation. Understand the central bank demand for money as well. That's another approach where we calculate a different way of determining money demand and money supply by the central bank, right? So what determines the level of aggregate output? We know that the South African Reserve Bank, which is SABS, operate monetary policy in South Africa. So the South African Reserve Bank announced whether the interest rate will increase, decrease, or stay the same. It also regulates all the financial market activities in the country. Later, you'll learn what actually is the mandate of South African Reserve Bank. If you continue with economics to 30 and stuff, you will actually discuss extensively what are those. So the model we developed in chapter 3 did not include interest rate, and that's why we are discussing this in this chapter. So that was a strong simplification, so we relax it here. To relax the assumption of chapter 3, we first look at what determines interest rate and the role of South African Reserve Bank in this determination. Second, we look at how interest rate affect economic activity. More of this actually will be discussed in chapter 5. To understand what determines the interest rate, we must look at the financial market. So financial markets are very important when you want to discuss about interest rate. By now, you would have heard of different types of financial assets, such as short-term bonds, long-term bonds. I mistype here, it should be bonds. Government bonds, corporate bond, and there are 1,000 different interest rates, right? So, so here we're gonna discuss through semantic trap, because people always confuse when people say you're wealthy or you have your income is high, or what is money. So we want to know, to clear that up before we continue. From the above assumption, we can then think of the determinant of interest rate. You will see that one way to solve this problem is to have interest rate determined by the condition that demand for money is equal to the supply of money. A second equivalent analysis show that if the South African Reserve Bank directly announces a target interest rate, it must then act in financial market to change the supply of money and achieve that interest rate. So income is what you earn from working, plus what you receive in the interest and dividends. So that's what income is. So it is the flow, i.e. it changes over time. It is expressed per unit of time, monthly income, yearly income, and stuff. Saving is a part of after-tax income that is not spent. Saving is sometimes used as synonymous for wealth. We won't use it here. So we have financial wealth, and financial wealth simply means that it's a wealth, it's the value of all your financial assets less all your financial liabilities. Wealth, on the other hand, is not a flow, it's rather a stock variable. It is the value of the wealth that at a given moment of time. You cannot change the total amount of your financial wealth. You can only change your wealth over time. Financial assets that can be used directly to buy goods are called money. So money is the most liquid asset. People joke that money is or cash is king. Money include currency and checkable deposits against which you can write checks. So money is also a stock. So investment in the other term we reserve for purchase of new capital good, machine to manufacture plant to office and and 2 offices building. So those are what investment are, right? So investment are things like capital goods, machine for manufacturing, plant to offices. Those are what we categorize as investment. When you want to talk about purchase of shares or other financial assets, you should refer them, you refer to financial investment, right? So you refer them as financial investment. As always, I recommend you to read interesting books on the subject. So here is one. You need to read, if you read Other People Money by John Kay, it's actually a good book. So you should read that. Spend some time on your lockdown now that you have ample time on your hand. Please don't spend on Twitter. Spend on making sure that you are very, very well informed in economic matters. Money serves as a unit of account, medium of exchange, or store of value, to mention the few of its functions. So now we're going to discuss demand for money. So money is used for transaction, but pays 0 interest rate. There are 2 types of money. So you have currency, which is coins and bills issued by the central bank, and checkable deposit. The bank deposit on which you write checks. Checkable deposit pays small interest. We ignore this here. So I see that I wrote here, there is a mistype, so be nice to me. This is coins, right? Bond, on the other hand, which cannot be used for transaction, but pays positive interest rate. So the interest rate is actually the opportunity cost of holding money. Every time you're holding money in your wallet, you are foregoing the interest rate that money could earn by being in the interest account, or holding a bond which pay interest. So holding all else constant, holding all your money in bonds involves some costs as well. Having to convert it every time you need to buy things. So that's actually some trade-off to your income. I know you know, but just to remind you, money is trust and useful in solving an intricate problem called coincidence of one. So that's why we have money. Imagine if every time you wanted a loaf of bread, you needed to have 2 books of blanchard for an exchange of bread. That would have been very, very bad transaction. So it's probably a good idea to hold both bonds and money, but what proportion? This depends mainly on two variables: your level of transaction. So you reduce friction, having to run errand to change from bonds to money. So that's your transaction level determine how much money you actually hold. If the interest rate is higher, you will probably want to hold interest-bearing assets. So interest rate on bond then is important. Most of you probably don't hold bonds, so you need to just chat with your parent to check what type of bond do they hold. Money market funds receive funds from people and firms and use these funds to buy bonds, typically government bonds. Money market funds pay you interest close to the interest on the bond they hold, the difference coming from administrative costs or running the fund and their profit margin. So you know that a 220, so of course 220 is a financial management idea where they charge you a 2% management fee, and then they take 20% of the profit they make for you in the market. So that's what the 220 in fact. Other possible reasons for demand for money are speculative purposes and precautionary purposes. So those are other 2 possible reasons why you should hold money. We can formally write what determines money demand then by saying money demand is given by your nominal income and the function of interest rate, where this denotes nominal income. The above equation says that demand for money is equal to nominal interest rate, nominal income times function of interest rate. So we denote that denoted by Li. So L, it has a minus underneath it. It's captured the fact that interest rate has a negative effect on money demand. An increase in the interest rate decreases the demand for money. The demand for money increases in proportion to nominal income. So if you increase your nominal income, then your money demand will increase. So I put just a summary here so you can remember that if you increase your nominal interest rate, your money demand decreases. If you increase your income, your money demand will increase as well. Okay, so here I depict a graph and I explain it here. So from the graph above, we see that for a given level of nominal income, a lower interest rate increases the demand for money for a given interest rate. An increase in nominal income increases demand for money. So i.e., if you hold this constant and decrease interest rate, your money demand increases. Similarly, if you hold interest rate constant and increase your income, your money demand increases. So the curve is downward sloping. The lower the interest rate, the higher the amount of money people want to hold, higher end. At any interest rate, an increase in nominal money shifts the demand curve, demand for money to the right. We could write the money then as this because you actually care on you actually care on real money and not nominal money. So it's a decreasing function of the interest rate. That's the equation predicted that when interest rate is higher, the ratio of money to nominal money should be low. When the interest rate is low, the ratio of money to nominal income should be higher. We sometimes refer to inverse of the ratio of money to nominal income, that is the ratio of nominal income to money as velocity of money. The velocity stems from the fact that when the ratio of nominal income to money is higher, the number of transactions for a given quantity of money is higher, and it must be the case that money is changing hand faster. In other words, the velocity of money is higher. Don Bush book covers this better, not prescribed yet relevant to read. So you should read that, right? So just quick things to make sure that this is supposed to be hands, not hands, so right. Determinant of the interest rate. So there are two suppliers of money. Bank supply checkable deposit and the central bank supply currency. Here we assume that all money is currency. We will introduce checkable deposit and look at the role of bank a bit later. Money demand, and money supply and the equilibrium interest rate. So that's what we want to discuss here. So equilibrium financial markets require that money supply be equal to money demand. So we have that. So we have this scenario. The above equation tells us that the interest rate must be such that people are willing to hold an amount of money equal to the existing money supply. The equilibrium relation is called the LM, and we will discuss this later in chapter 5 going forward. The interest rate must be such that the supply of money is equal to the demand for money. The effect of an increase in the money supply on the interest rate, so if you increase your money supply from that to that, it leads to a shift of the supply kept to the right, and interest rate decreases from that to that. Thus, an increase in the supply of money leads to a decrease in the interest rate. The decrease in the interest rate increases the demand for money so that it equals it equals the larger money supply. An increase in nominal money leads to an increase in the interest rate. Lastly, so an increase in your nominal money leads to an increase in the interest rate. Lastly, an increase in the supply of money leads to a decrease in the interest rate. Okay. So monetary policy and the open market operation. Central bank then changes the amount of money in the economy by buying or sell bonds in the bonds market. If it want to increase the amount of money in the economy, it buys bonds and pays for them by printing money. If it want to decrease the amount of money in the economy, it sells bonds and remove from circulation the money it received from the exchange of bonds. Such operations are called open market operation, and that's how the central bank can influence the amount of money and the interest rate in the economy. Again, so you could actually watch the documentary Ascent of Money, where they talk about bonds market in one of the episodes. So it's quite a good way of conceptualizing some stuff in the bond market. For simplicity, assume that SA, but I'm gonna discuss an example here anyway. For simplicity, assume that South Africa Treasury bills or T-bills promise to pay a given number of rand 1 year from now. What will the interest be? If we assume the bond to be a 1-year bond with a price that, if one buy the bond today and hold it for a year, the rate of return on holding the bond for a year is given by this, right? So you see that when interest rate goes up, the price of bond go down. And when the interest rate goes down, the price of bond goes up. So there is a negative relationship between the price of bond and the interest rate. All right. So expansionary open market operation is an operation in which the central bank increases the supply of money by buying bond. The demand for bond goes up, increase the price of bond. Conversely, the contractionary open market operation refers to the situation where central bank decreases money supply by selling bond, which leads to a decrease in the price and an increase in the interest rate. So you need to remember that when you're reading your book. Right. Now we move to determinant of the interest rate, part 2. Again, banks are one type of financial intermediary. They receive funds from the depositors, keep some of these funds as reserves and use the rest to make loans and purchases. Banks keep as reserves some of the fund they have received, and then the rest they can loan out, right? So bank holds reserve for 3 reasons: demand for money, so just they demand for currency, so there could be demand for currency. People will go and try to withdraw their currency, and let D be this be for checkable deposit. So we could have demand for currency at that, and less for checkable deposit. Now, your demand for currency is a proportion of your demand for money, given the first component of demand for central bank money. The demand for currency by the public then. So we have that demand for deposit or for checkable deposit, that is 1 minus that. And the demand for, this is the demand for checkable deposit. The demand for reserve, the larger the amount of checkable deposit, the larger is the amount of reserve the bank must hold to allow customers to retrieve cash or clear check between banks. So if you let theta be the reserve ratio, and let R denote the rand amount of the reserve of bank, let D denote the dollar amount of checkable deposit demanded for reserve. So you have that the rand amount, the reserve, so the amount of reserve is given by theta times D, which is dollar amount of checkable deposit. So if you say R over D, it actually implies theta, which is your reserve ratio. So the demand, remember that, that's important, that this theta is nothing else but you are taking your reserve divided by your checkable deposit. So sometimes we give you either theta, or we give you this and this, we give you reserves and deposit, and you should be able to calculate your theta. The demand for central bank reserve is given by this then. So of course, if you look at this equation, you know what is D, so I just bring it here. So RD will be theta, and then D is that, so I substitute it here. So I get that. So the determinant of the interest rate, the demand for central bank money is equal to the sum of the demand for currency and demand for reserve. So we take that H is equal to that plus that. But we already know what is RD and we know what is CUD. So we actually incorporate both of them here and we get that, right? So we simplify by getting H is equal to that. And then remember that MD from our initial discussion was given by that, right? So that's why I can substitute it here to get that. Simplify to get the following, so we get H is equal to that. The supply of central bank money is equal to the demand of central bank money on the right-hand side. The higher the interest rate imply a lower demand for central bank money for 2 reasons. As demand for currency goes down, the demand for deposit also go down, leading to a decrease in the demand for reserve by bank. The supply of money is fixed and represented by a vertical H line. As before, an increase in the central bank money lead to an increase in interest rate. Right. So two ways of looking at the equilibrium. There are 2 alternative ways of looking at the equilibrium in the financial market. One is through the condition that the supply and demand of reserve be equal. H minus CUD should equal to that. Supply for reserve is equal to demand for reserve. The other is through the condition that the supply and demand for money be equal. So that's the one where from here, I can just take this to that side, so H over that. Now remember, 1 over this thing is called the multiplier, right? So the other is through this, so remember that 1 over C plus theta, 1 minus C. This ratio here is called the money multiplier. So 1 over this is a multiplier. So the supply of money is equal to demand for money, where that is the money multiplier. Now understand what happens if you increase C or decrease C or increase theta. How does the multiplier change? So it's an important thing where we expect you to conceptualize and be able to understand and be able to calculate them. Right, example. So consider an economy in which the aggregate demand for money is given by this. And suppose that you have your nominal income to be this, and the money supply is given by that. Compute the equilibrium interest rate. So of course, you know that money demand is equal to money supply. So you equate these two, and you know, so you write money demand to be given by that, and equilibrium money demand equal to money supply. You equate and solve, and you get that your interest rate is nothing else but 0.27. If the money supply was to go up, then the interest rate will actually, if you increase money supply, the interest rate fall. Another example, suppose that the person wealth is that, and that her yearly income is this. Also suppose that the money demand function is given by that. What is the demand for money and demand for bond when the interest rate is 5, 10? Remember that the sum of money and bond demanded is total wealth. So it means that this total wealth is given by the sum of money demand, the sum of money and bond demanded in the economy by this person. So describe the effect of the interest rate on the money demand and bond demand. Is it consistent with the theory in chapter 4, and why? Suppose that the interest rate goes up by 10, the interest rate is 10, is percentage term, in percentage term, what happened to her demand for money if her yearly income is reduced by 50%. Suppose that the interest rate is 5%, in percentage term, what happened to her demand for money if her yearly income is reduced by 50%, right? So summarize the effect. So when we start, we know that MD plus DB is equal to demand for bonds is equal to total wealth. So when you take that equal to this, you can solve that demand for bond is 32, and for interest rate equal to that, demand for bond is equal to that. So when the interest rate is what? Is 5, you're demanding that. And when the interest rate is higher, that's going up, right? So higher interest rate, we demand bonds. Describe the effect of interest rate on the money demand. An interest rate rise, demand for bonds increases contrary to, this is actually what we expect, that at a higher interest rate, we should demand what? We should demand bond. Why? Suppose that interest rate is that, in percentage term, what happened to the demand for money? So I think this is incorrect. It should be that as interest rate goes up, we demand more bonds, right? We cut away with our money to demand higher bonds, right? Because bonds pay interest, so high interest should signal us to purchase higher bonds. Again, if the income is reduced by 50%, so surely what was the income? The income was 60, so it just becomes 30, and you should compute it at 30, which is what I did here, and you get that, right? And then when income is reduced by that, but interest is that, it becomes that. The effect of income on money demand, how does it, at higher interest rate, we demand less money compared to at lower interest rate. So that is why I'm stopping today, and thank you very much for watching this, and I will see you soon for discussion of chapter 5. Have a wonderful time and stay safe.